In today's episode, I'm going to share with you the biggest mistakes beginner traders are making when it comes to reading candlestick charts, performing technical analysis, and choosing the correct places to buy and sell. I know about all these mistakes because I made them myself when I was getting started. And here's the problem. If you don't perform technical analysis the right way, you're going to believe you see buy and sell signals on a chart, but you're probably the only person that's seeing them because they're not correct. The result is the price is sort of erratic at those levels and your trading performance is inconsistent at best, losing at worst. 90% of beginner traders are making these mistakes, and it's not your fault. It's just the result of, well, we don't learn this stuff in school, so we kind of have to learn it the hard way through trial and error. My hope is that by watching this class today, you are able to learn the right way to perform technical analysis. Now, to make the most of this class, I have a PDF handout for you. It's a 112-page PDF of all of my favorite chart patterns that I want you to download. You can download this, you can print it out, and you can have it side by side with you as you're going through this class. So let's go ahead and dive into that first mistake that most beginner traders make. Have you ever heard me say the phrase, trade the best, leave the rest? Or maybe you've heard me say that when I'm kind of struggling, I need to focus on A quality setups and not touch anything else. Sometimes beginner traders will misinterpret this to mean that I should only trade certain patterns. Let's jump onto the whiteboard and I'll show you what I mean. So let's talk about just a pattern, one of the patterns that I like, which will be in the PDF download. This is going to be a bull flag pattern. So we have a couple of nice green candles. You have a couple of little candles of pullback here, no big deal. And typically when I see this pattern, I'm a buyer. As soon as we have a first candle that makes a new high, we call it a candle over candle pattern. Now, what's happening in this chart pattern right now, in this candlestick pattern, we have a burst of momentum that began right here. Typically, this started with some type of news catalyst. All right, all of a sudden the price surges up and then we get a momentary correction. During this momentary correction, let's just talk not about the candlesticks, but about the psychology of what's happening. What's happening in this moment is that the people who were in before the news are going to take a little profit. They're like, whoa, that was awesome. I'm going to take a little profit. That was unexpected. Maybe there's some early short sellers who decide to create a negative position by going short. There's a little bit of a pullback. But it doesn't go all the way back down to where it came from. It stabilizes. And that's because some buyers have come in with demand, supply and demand. So buyers have come in and said, you know what? I like this. I want to buy this. I think it's going to go higher. Now, when we're looking at a chart like this, I want you to know that it doesn't matter if you're talking about trading stocks, Forex, cryptocurrency, or futures. This is the universal language of the financial markets in candlestick charts and technical analysis, so you can apply it to whatever. I choose to trade stocks myself, but it doesn't stop you from applying what you learned today to a different market. So we have the first move up where there's a surge of buying, then you have a momentary pullback. And then first candle make a new high right here, this is where the buyers come back in and we go to that next leg up. Then after a second leg up right here, it's very common that we'll see another momentary pullback. A momentary pullback and then followed by another surge higher. So this is a pattern that I trade. My accuracy is currently about 68% and my profit to loss ratio is about 1-to-1, which means my average winners and my average losers are about the same. So on a trade like this, if I bought right here, my max loss would be the low of this previous candle, and my profit target would be first a test of the high, and I would typically sell half right there to be conservative, and then I would sell another quarter up here, and another quarter right when we get that first candle that makes a new low and goes red. So this is a pattern that I love to trade. But what sometimes beginner traders will think is that this is such a great pattern. I need to start scanning the entire market for this A quality setup. They think that the setup is just the chart pattern and that the only reason this worked was because you had 1, 2, 3 green candles, 2 red candles, and then 3 more green candles and 2 red candles. So what do they start to do? They start to create these scanners to search for this type of pattern. They're scanning for a stock or whatever it is that's had 3 candles up and now 2 small red candles on light volume, and they start spending a lot of time searching for these perfect patterns. I understand where the desire for this comes from, because when I was getting started, this was one of the first patterns that I got really dialed in on. It's a great pattern. And I logically thought, as a beginner, if I could just find this pattern 15, 20 times in a day, trading it with 68, 70% accuracy, I'm going to make my daily goal. And that's the only way I'm going to hit my daily goal, is just by finding this pattern as many times as I can. But that is a mistake. Why is that a mistake? This pattern works and resolved not because you had 2, 3 green candles in a row and then 2 or 3 red candles and then it moved back up. That's not why it moved back up. Why is this moving in the first place? Let's step back for a moment. This is moving because traders like not just the technicals, they like the story. They like everything about it. Maybe this is an example of something that's been selling off for a long time. It's been beaten up. Could be something like GameStop. It starts to squeeze up, and now in that first pullback, people are saying, I want to get in on this thing that's strong, and a pullback, this just gives me a way to manage my risk better. So this works well because the underlying asset is interesting. And again, it could be a cryptocurrency, it could be a currency pair, it could be a futures contract, or it could be a stock, but it's the underlying asset that is interesting. So when I'm talking about a perfect setup, I'm not talking just about a chart pattern. The chart pattern is only one component. So what are the other components for a perfect setup? Well, let's talk about strategy for a second. So for me, and you probably already know this, but I'm a momentum day trader. So I trade momentum, which means I'm looking to ride these moves higher, buying the dips here and taking profit into the move up. The same as what you're seeing here. Now, momentum is in contrast to a trader who's a counter trend trader. You're usually one of 2 things. You're either trading momentum, trading with a trend, or you're trying to predict reversals, shorting stuff that's strong or buying stuff that's weak. I'm not a counter trend type of person. It's a little bit of a personality thing. Counter trend is also a way of thinking. Like, I just sort of want to do the opposite of everything else. And that's not the way I think. It's not the way I trade. I'm more like, I like to go with the flow, and I'm kind of easy-go-lucky. Like, let's just, that's kind of like my personality. So I trade in that similar way. Okay, so as a momentum trader, what I'm looking for is ultimately one very important thing. I'm looking for volatility. All right, so if we have volatility, that means we have something that is moving. I don't make money buying something at 5 and selling it at 5. I make money buying something at 5 and selling it at $10. And I would love to do that inside of, 15 minutes. That would be a phenomenal trade. Now, just as an example of that today, we could look at a stock that I traded this morning, ONMD, and this actually went from a low just 2 days ago. We can pull out the daily chart and take a peek. We'll scroll back. This was about 50 cents a share, and today it hit $3. So just a nice, cool 300, 400, 500% move in 24 hours, 48 hours. This is a stock that had a news catalyst. People were excited about it, and that's why these patterns worked so well. Now, in this class, I'm actually going to show you a live trade that I took on this stock where I bought this pattern right here. But I want to remind you that that's not alone what made it an A-quality setup. Okay, so we look number 1 for volatility, which means essentially rate of change. So we can determine volatility, and I determine it by making sure something is up at least 10% on the day. If it's not up at least 10%, it's not volatile. So we need volatility. Number 2, we need volume. And especially when volatility and volume, I'll just draw the little volume bar here. So we need the volume here because this is what creates the liquidity that allows you to get in and get out. And what I particularly like is high relative volume. So relative volume is the measure of today's volume relative to what's normal over the last 14 days. So if normal volume over the last 14 days is 100,000 shares a day, and today it's trading 10 million shares of volume, you've got 100 times higher than average. That's phenomenal. What's the reason you've got 100 times higher than average? Number 3, news. So this is a perfect setup from the perspective of the actual financial instrument that we're trading, which in my case is going to be the stock. This is perfect. This is exactly what I like. Now, to juice it up even more, I would like to see that the float, which is the number of shares available to trade, is less than 20 million for sure. Less than 10 million is preferred. We look at this stock today, the float is 9.8 million shares, and we can see that. Let's see. Let me just grab it for you right there. So 9.8 million shares is the float. That's right here. You'll see that on the scans right there. You'll see it on the scans right over here. 9.8 million shares. It's got 115 million shares today. So let's look at the volume that this traded just 2 weeks ago. 44,000 shares in one day. So the relative volume ratio on this is insane. It's super, super high. Now, it's also really high because yesterday's volume was 198 million shares yesterday. So why does the stock go from 44,000 shares to 198 million in one day? It's got that news catalyst, and that's what creates the imbalance between supply and demand. That's what creates the big move. So the reason that the patterns worked on that wasn't because of the pattern alone. This is very isolated. When you look just at the candlestick chart, you might think you see a great pattern. But whether or not the pattern is going to resolve is going to be related to this stuff right here. This is more about the context. And to a certain extent, this is the combination of technical analysis with a degree of understanding trading psychology and understanding some degree of fundamentals. What makes stocks go up? Stocks aren't just moving at random. They're going up or down based on things that are happening. And this is really important. So when I was getting started, because I had such confidence in this particular pattern, I just started scanning the entire market for this pattern. I created these elaborate scanners that were looking for a certain number of green candles, a certain number of red candles, where the price was just above these moving averages and this and that. And so what would happen is all of a sudden I would get an alert on my stock scanners right here. The alert would come through and it would be something like this. The alert would come through and I'd pull up the chart and I'd look at it and I would see, oh, okay, I guess we kind of do have like 3 green candles. Let's just say this, for instance. Okay, technically you've got 1, 2, 3 green candles and then 2 red candles. Should I be buying this? Well, this is U.S. Steel. It's got 183 million share float. It's not a small cap stock. And why would this continue to move up? And this is the illusion. It could have a picture perfect pattern here. This could be picture perfect. And in fact, it's not terrible. High volume green candles, light volume red candles. First candle to make a new high would have been right here. It's not bad. But this has no reason to move higher. People are not watching this. It's not an obvious stock. So there are over 10,000 stocks you could choose. I can't even count the number of cryptocurrencies you could choose. You've got Forex pairs, you've got future contracts. So how do you choose it? Do you just search for whatever one has your perfect pattern and then trade that perfect pattern? That's what I tried, and it was a big mistake and it didn't work. The result was inconsistency. And I was inconsistent because these patterns were not destined to resolve. There weren't people interested in the stock. There were not people out there studying it, watching it, waiting to buy. In fact, in a sense, this pattern, it's more of just I don't know the best way to say it, but it exists just because of a couple of traders that executed trades, a couple of algorithms that the orders went through on. It's almost like it's a coincidence that this is a pattern. So you would be reading into something that's not there if you try to do technical analysis when there is not relative volume, when you don't have that percentage change of 10%, when people aren't watching it. So if a tree falls in the forest and no one's there to hear it, doesn't make a sound. If a stock has a bull flag and no one's there to see it, nothing will happen because it doesn't respond and react and go higher unless people are watching it. So like a traffic light, if a traffic light at an intersection turns from red to green, but no one goes through, it's as if it never happened. It doesn't even matter. It's irrelevant. And so you have to tie back your technical analysis to making sure you're trading the right stock. This is such a big mistake that I see traders make. They'll come to me and they'll say, Ross, hey, I was just looking at, Sirius satellite radio. It's got a nice pattern right now. And, this is obviously kind of an extreme example because this looks like a barcode. There's not a pattern there. But they'll pull up something like that and they'll tell me to look at it and I'll be like, you are focusing on 100% the wrong type of stock. And they think, well, but the pattern looks perfect. And again, it's not about the perfect pattern. So then if it's not about the perfect pattern, what's more important is that you're trading the right instrument. So the right instrument, even if it doesn't have a perfect pattern, is still going to be an A quality setup or the trade the best because it's the right stock to trade. So let's just say, for instance, that this is the chart pattern that's begun to form right here, and that this is actually a perfect stock. It's got news, it's got everything we look for. Okay, it squeezes up right here, but we notice on the level 2, on the order book, that there's a 30,000 share seller, right here at the top. So this is forming resistance. So the bull flag doesn't resolve. It ends up coming back down. The price drops. It dips back down. And then maybe it holds. There's a buyer down here, and it comes back up for another attempt. But that seller is still there. It can't break. It's not able to break. So at this point, we would say, well, this could be an ABCD pattern. ABCD pattern is when you get A, B, C, D, and you break out on this candle right here. But let's just say that seller now is 50,000 shares. There's an even bigger seller there. It can't break that level. It pulls back again. In this case, it actually drops down a fair bit. And then maybe half an hour later, whatever it is, it sort of creeps back up here. And then it pops and pulls away. All right. Now you're watching that first little dip right here, and you buy a micro pullback for a move higher. And you might be thinking, Ross, I don't understand this trade right here. This was such a clean bull flag, but, it didn't really work. And then this is like a micro pullback. It's not even a full bull flag. And what I would say is that on the right stock, I'm willing to trade any pattern that I see where I feel I can manage risk. So managing risk means buying as close to support as possible, right? Because if you're getting in near support, you don't have to worry about losing a lot. The riskiest trades are when we buy at the very top of a move. When we get in way up here, that's going to be high risk. Now, getting in right here, for me, is lower risk because I'm getting in right after a red candle. So the most important thing is that you're focusing on the right stock. The pattern is not everything. Now, you need to learn all of the different patterns. That way, when you see the right stock, you're willing to apply any pattern that you know to that stock. So maybe it's an ABCD pattern. Maybe it's an opening range breakout. Maybe it's a bear flag. Maybe it's a bull flag. Maybe it's a cup and handle. It's a head and shoulders. It's a flat top breakout. It doesn't matter which pattern it is. All of these patterns are ways that active traders put price action into context to help us understand how much we're risking versus how much we stand to gain. It's all about risk and reward and understanding the places where we can get in close to support. So now the second big mistake that a lot of beginner traders make is that they don't correctly draw their support and resistance trend lines. So this makes it nearly impossible to find entries off support. Let's jump back into the whiteboard. Okay, so let me draw something for you here. What we know is that most stocks trade with a high degree of respect to half dollars and whole dollars. So if you have a stock at 10, for instance, 10.50, 11, 11.50, 12. All right, so we're just going to kind of draw this out here, and we're going to just pretend that this is sort of the current order book here. So what we'll notice is that most of these stocks will have lots of orders right around the whole dollar of 10, and then a ton of orders around 10.50, and then a ton of orders around 11, and then a ton of orders around 11.50, and a ton of orders around 12. All right, this is very common. So the result then is that we have psychological resistance that's formed at each of these areas. So this, let's say there, and then there. This is just approximate, but you're going to get the idea. All right. So if we were watching a stock that hit the scanners and started to push higher right here, we would expect it to have some resistance at about 10. It then pulls back for a moment, very common, and now we're getting our pullback pattern. So this becomes resistance. We hit this level, we pull back. So this is an area where there's a lot of supply. All of these orders here create supply because there's people that are selling shares. So we have supply coming into the market. That drops the price down. The price then starts to move back up because, remember, this has a news event. So there's a reason people are buying it and they're excited about it. It breaks through resistance. And then following a break of resistance, what is very common? A retest to prove it can hold that level. So first we break through it, and then we come back down, and if we can hold above this level, this changes from resistance to support. If this is now support, now we can get in right here, and that is our max loss. So we're always trading around these levels that are going to be perceived support or resistance. So here we have resistance at 1050. We break through it, very common. We dip down for a moment. We then push higher. And then again, we might dip down for a moment. If we can hold that level and push higher, each of these pullbacks right here become new areas of support. So when I'm trading these pullback patterns, I'm always looking at the last dip. I establish that as a support level, and I want to see that when we get above it, the price can hold above this level. So let me show you this chart here from today, because this is a really great example of how this played out in real time. So ONMD is the ticker, but it doesn't matter because it could be any stock. It's just this just happens to be the one today. Okay, so I'm going to clear this drawing out. So I'm going to right click, I'm going to remove all the drawings, and we're going to go over here. We're going to scroll over. And what I noticed yesterday was that the price squeezed up right here. We had this nice move up. We then pulled back, we popped up, and then we dropped, and then we kind of couldn't get it back above this level. And so I sort of noticed there was an area here that it felt like was establishing as possible support or resistance. And so I actually drew that level at $2.18. I said, you know, it looks like 218 sort of was support right here. And then when the price broke it, it tried to get back above it. And when it couldn't get back above it, well, 218 became resistance. So this is very common. Now, this is called a horizontal level of support or resistance. It's exactly horizontal. And these are typically lined up around $half and whole dollars. Although in this case, this is at 218. It doesn't happen to be at that half or whole dollar. And that's fine. It's still a valid level. So then the price comes up, and watch this. It breaks above it, and then it comes down and retests it. And so I said right here, this is where I want to be a buyer. I already had this level drawn. I said I want to be a buyer right here off of 218 because I think that that was a previous support resistance level. So we've broken it right here, but I think we're going to retest it. We retest it, I'm entering right there, and then we get this push higher. Now we dip down, we pull back. This is another pullback. Max loss is the low of this red candle. And then we get another surge higher. We go up to $3.10 right there. Now, this ended up being a really clean pattern. Now, let me show you a live trading archive of this trade from today. I think you'll find this really interesting. So I'm actually going to show you my pullback pattern that I traded on this. Okay, so we're looking at ONMD right now. And to help you get oriented, this is my actual trading platform that is right in front of my computer, is right on my computer screen, right in front of me while I'm sitting here trading. So this is the stock that we're looking at right here. Sorry, right here in this box. This is the stock that we're looking at. The ticker is ONMD. On the green on the left are all the buyers. They're buying at $2.67. On the offer are the sellers selling at $2.69. They're stacked up on the sell side. Buyers are stacked up on the bid side. This is the chart pattern right here. Now, as we squeezed up here, I was watching on this time frame right here. So notice we have our pop-up, we have a little pullback, and I'm waiting for a 1 minute pattern to form. So I end up here as it curls back up, jumping in on a micro pullback at 71. Now, my full size on this type of stock is 20,000 shares. So I bought 5,000 shares, which is a, for me, conservative starter position. So I bought 5,000 shares. I've got my starter position. And what I'm looking for is for this to squeeze through that high of 280, which is our high of day. Now, it hasn't happened yet. And now we form a red candle, which is fine. So we start dipping down. We had 3 green candles in a row. We now have 1 red candle forming. We may have another one that forms. I'm going to add to my position down here. And what I'm going to look for is that first candle that makes the new high and squeezes up. So let's jump this forward just a smidge. All right, so I'm sitting here. I'm going to add to the position. So now I've added to my position, and I'm still looking for that first candle to make a new high. So you see how this candle is green right now? It's green, which is good. And we want to see the next candle make a new high and break like this. If we break 280, our next target logically is $3. That's psychological resistance. And what we know is that most likely when we come up to $3, there will be a lot of what? There will be a lot of sell orders up here at $3, right? Okay, so right now the price is coming up to $2.70. We're starting to get that first candle making a new high. We dip down for a moment, but what's our max loss? So our max loss is the low of the previous candle or the low of the pullback. So I'm still holding my position. I have not gotten stopped out of the trade. Now keep in mind, this has 50 million shares of volume. It's up 79, 80%. This is one of the most obvious stocks in the entire market. Everyone is watching this. Everyone who is an active trader is watching this. And so when this breaks 75 and 80, there's a lot of people who are going to want to watch to buy. So watch what happens here. We're pulling back. We're down to 65. We're still holding because it hasn't triggered a stop loss yet. 68 on the bid, 69 on the bid, 72 on the offer, 73, 74, 75, 77, 80, straight to $3. Instant $2,000 of profit. Do you see how it went straight to 3? And what does it have at 3? It has resistance. It has sell orders. It went straight to $3. Let me back that up and we'll play it again. So right here, 75 breaks, and we go instantly all the way up. So we'll play it one more time. It's going to break through 75. A burst of buy orders come through. Now, this is a pattern where we got that first candle making a new high, and then it surges up. So when we go look at this pattern, we say, wow, that's the pattern. 1, 2, 3, 1 red candle, and then it's surging back up. But this squeezed up with all of that volume, not just because of the pattern. This met the criteria of being the right stock to trade. It had the volume, the volatility, the volume, the news, the float. All of that is what created the story around it. This was the most obvious stock to trade in the market. So we're trading the obvious stock. And in this case, we're trading right around those support and resistance levels. So one of the biggest mistakes that a lot of beginner traders will make when it comes to drawing support and resistance levels is that they will not draw them correctly. And they don't understand that you're going to have resistance around psychological areas. So in order to draw support and resistance lines correctly, let's see. Let's pull up what was the stock that we had this week? I'm going to pull up my continuation scanner here. This is a good one. So GTBP. All right, so we're going to pull this up here. We're going to look at the 5-minute chart. I'm going to back this up a little bit. All right, so let's look at this for a second. So drawing levels at $0.50 and whole dollars is very easy. This is a $0.50 right here, just over the $0.50. So you got your $0.50 right here at about $8.50. It kind of comes up to that level. It can't hold above it. It breaks back down, comes back up. And you can see that this has sort of struggled at that 850 level a couple of times, kind of trying to get above it, trying to get above it. It breaks it, but doesn't hold that level. So that's a fairly easy level to draw. You can see it pretty clearly. Then you've got support down here around 750. Again, fairly easy to see that channel that the price is within. Okay, but where it gets a little confusing is when you're drawing support and resistance lines that are on angles. So you start drawing something like this, for instance, or you say, well, I want to try to find the spot where this seems to kind of touch in the most places. And that's what I do. So I don't have to connect the tops necessarily, but I connect the candles to make sure that it touches in the most places. Now see this one only touches in two spots. One, maybe two, kind of here. It's a little steep. Some people would draw it, but it's a little bit of a steep trend line. This one right here is connecting once, twice, 3 times, and 4 times. So because this is connecting more times, I would say that this is a more valid resistance line. So now let's move forward. Let's watch. I mean, it's way up there at $13 a share. It's probably too far away to even really be relevant, right? But watch this stock as it busts through 850. It breaks through 850 right here, and it goes up to where? To 950. Then let's watch this pullback. We pull back and we squeeze, and look at this. Look at that. We stall out right at that level. Wow. Now, if you didn't have that line drawn, you probably wouldn't have realized that that's going to be resistance. So learning how to draw your support and resistance lines is super important. Start first by drawing the horizontal lines where you see clear resistance. And always think it should probably be near the $0.50 and the whole dollar, because that tends to be the spot where we see these stocks kind of top out and then reverse. And the reason is because you have so many sell orders that are kind of congregating around these psychological levels. I think it's just human nature that people will get into a trade and be like, oh, I'm just going to put my profit target at 10, 10.50, 11, 11.50, 12. It's just simple numbers, so that's just what people do. All right. Now, it's the ascending support lines that are going to be a little trickier. This is a really nice one here that played out, but they work not just on intraday time frames, you can even use them on daily charts. So let's talk about Tesla for a second. So we're going to go full screen on Tesla on the daily chart. And all of a sudden you look at this and it's like, well, wait a second. I look at this and I start to think, do we have any sort of ascending support in these areas or ascending resistance in these areas, right? And you start to back this out and you realize, okay, there are some levels that are in play, right? So maybe this second one is a little bit more accurate than the first one. You see, we've got 1, 2, 3, 4, 5 taps. We switch to the S&P 500. You do your technical analysis on the S&P 500, you're going to realize that we're going to come into ascending resistance up here pretty soon. So you've got this very steep trend line up in this area. Probably move it out just a smidge. And then we had a support channel right down in here. Okay. Now, it wouldn't surprise me at all if when the price comes back up to this area, if this forms as a little bit of resistance. So this is something that you can apply to any time frame and you can apply it to any financial instrument. But if you try to apply this to, your General Electric, your kind of just miscellaneous stocks, you're not going to see good performance. Your technical analysis isn't going to result in profits because you're trading the wrong stuff. If you're an active trader, if that's what you're trying to do, you're trying to trade actively, you need to make sure you're trading stuff that other people are watching. So here's Lucy. This is up 74. This is up, sorry, it's 74 cents. It's up 300% on the day. So this is where you're going to see nice patterns. Now, they're not all going to be picture perfect, right? But look at this right here. That's a nice first pullback, and that's a really nice second pullback. Those are clean. Now, this right here, the third one, starts to get a little extended. That's not surprising. Right here, it pulls back a little bit, kind of rallies back up. This is a little bit more of an obscure pattern. The break over 60 cents, maybe the break over 57 cents, these pivots. Pulls back a little bit more, it comes back up. But because you have so many people watching this stock, you're going to have better performance on it. Because when it breaks certain levels, there's just going to be more people that are buying those breakouts. That are trying to ride that momentum. So It again comes back to making sure you're trading the right stuff. If you're not trading the right stuff in the first place, perfect technical analysis, it doesn't matter. And similarly, you could do a huge amount of fundamental analysis on a stock, but it's not interesting. Nobody cares about it. No one's talking about it. Nobody cares that you like wearing your Fitbit. People have moved on. I don't even know what happened to Fitbit, but you get the idea. So this is just the reality of the market, that you've got to trade what other people are watching. So if we sort just by volume, right now we have 687 million shares of volume on Lucy. This is what's obvious right now. Now, earlier today, it was ONMD that was more obvious, which is the one that I traded. It's got 118 million shares of volume. I also traded AKAN. It's got 35 million shares of volume. These are the types of stocks that I'm going to trade on any given day. Now, if you're trading Forex, you're trading cryptocurrency, you're trading futures, you're going to want to trade the ones that have the most volume and the highest relative volume, and that are up the most. These are the ones that people are going to be paying attention to. And of course, there's scanners that have been developed for these markets as well, because it's a well-known strategy. If you're a volatility trader, you need things that are moving, and you need to be able to find those things in real time. Okay, now let's talk about the third mistake that so many beginner traders make when it comes to technical analysis and reading candlestick charts. They overcomplicate it. They drastically overcomplicate it. So when we're talking about a candlestick chart, just for instance, I have seen traders who make their charts look completely insane. And they do it by adding a ton of unnecessary technical indicators. I mean, I could add indicator after indicator after. I'm only in the A's. Here's some B's. Look at all these indicators you can add. You can add them all. Sure, why not? And I've seen people do it. I've seen people just go absolutely crazy adding all of these indicators. And ultimately, there's a reason that they're adding them. We're in the M's. There we go. Go further down, further down, further down. So they add all these indicators in hopes that they will avoid losing. This is a crazy chart. This is not a chart that I would ever want to see any of my students at Warrior Trading using. Because the problem is, when you do this, you get analysis paralysis. There is no way before you take a trade, you're going to be able to check every single one of these indicators to make sure it's giving you the right signal. And even if you could, there are going to be times where, well, they diverge. 7 of the indicators say yes, 2 of them say no. So now what do? Is it majority rules? Is it it has to be unanimous? This is not the way to trade. And the problem is, see how small the candlesticks have gotten? When traders get into this kind of mindset, the candlesticks almost become, they stop looking at them. And that's a major problem. The candlestick patterns are really, that's the source of seeing the sentiment. The candlestick pattern is the visual source of sentiment. It shows you the historical bias that people have had. It gives you the context. If you're not looking at those candlestick charts, you're missing out on the buy and sell signals. So you need to keep the candlestick charts up, and you need to get rid of all of these excessive indicators, because these are not going to help you be a better trader. Okay, so if that's not going to help you be a better trader, what will? Well, I think keeping it simple is really important. So let's talk about these charts right here and how I've kept it simple. So what do we have on the charts? Well, you'll see not too much. Pretty much all of my time frames are more or less the same with a couple of exceptions. So this is going to be the 1-minute chart right here. And this shows our that trade I took on AKAN. No, this was, it does show a trade on that. But anyway, so let's go over the indicators that I'm using. All right, so to keep my charts simple, I, of course, number one, need my candlesticks. All right, so we've got the candlesticks right here, and of course they're colored green and red based on whether they're going up or down. Okay, that's straightforward enough. Now, I like using moving averages. And did you know that nearly all traders have moving averages on their charts? The reason is because they're default on most charting platforms. A moving average helps give context to the current price, so it's not just floating there kind of out of nowhere. It helps you visualize support. And what we know, and I'm going to clear out all of my trend lines on this So we're going to remove all the drawings here. What we know is that when the price pulls back, usually we come down to one of these moving averages. So I have 3 moving averages on all time frames. 9 EMA, exponential moving average. 20, exponential moving average. 200, exponential moving average. I have them on all time frames. I also use them on the daily extensively. So this, it just keeps it simple. You see, if the price breaks the 9 EMA, which is this gray line, the next level is a 20 EMA. If it breaks a 20, the next level is a 200. But what's this orange one in the middle? That is the volume-weighted average price. Volume-weighted average price. This is a type of moving average, but it factors in the amount of volume that is traded over the course of the day. So it's not just a simple moving average or an exponential moving average. It actually is factoring in the volume that has taken place. So when you have a lot of volume, as we had, let's see, right on this candle here, a lot of volume, that pushes that VWAP, the volume weighted average price, a little bit higher. So this represents the equilibrium. This is the exact equal price of the stock over the course of the day when you factor in all the shares that have traded and the volume. And what we notice is that the price, when it's above VWAP, is bullish, below is bearish, and when we have these dramatic break above, break back below, we see volume come out. When we start to break back above, volume comes back up. When we see a breakdown below right here, we've got a lot of volume. So there's a lot of people that are buying and selling at this position because below VWAP, we're bearish. So now long traders are bailing out, shorts are adding. Above is bullish, so then we flip-flop, we switch. Now, when you have a stock that's dropping below and popping above, you have a lot of volume because people are getting in and getting out. This is very common that we'll see when the price is below, it'll come up and then reject, drops back down. So if you didn't have this volume weighted average price on your chart, you wouldn't have been able to predict this reversal right here. Whereas I was predicting that. I knew that I knew that if it wasn't able to get over that level, that was going to be resistance. I didn't know it was going to drop this much, but I knew that this was going to be a resistance level. So if you get your chart so messy that you can't read your indicators, they're going to serve you absolutely no purpose. Technical indicators only work if you use them consistently. If you use an indicator only 1 out of every 10 trades, then how do you even measure that it's working? You're not enforcing it consistently. You have to check it on every trade you take. Okay, so we've got the candlesticks, the moving averages, the VWAP. We have 2 more indicators. Where's my blue? Okay, so number 4 is volume bars. And the volume bars on the chart are very simple. They just show the amount of shares that were traded on each one of these candles. But visually, it's very important. Now, some traders will overlay it on top of their candles, kind of like this. And that's fine. The only problem is when the price starts to drop like that and they're on top of each other, it's a little hard to read. But it's okay to do that. It's not a problem. I just, by default, leave it on its own pane down below or its own panel, but you could overlay it. And then the 5th indicator is MACD. So MACD, MACD stands for Moving Average Convergence Divergence Indicator. And that is this histogram right down here. The MACD is an oscillator, which means it goes up and then it goes down, and it's reacting to changes in the moving averages. So it's called the Convergence Divergence Indicator, which means it's measuring when the moving averages are diverging and moving apart, which is when the price is moving quickly. It could be moving up or it could be moving down, but it's moving quickly. And then converging is when they're coming back together. All right, so moving average convergence divergence indicator. What I know is that the cleanest moves are always at the beginning when the MACD is very open, as it is right here. And once we have that first crossover, usually I stop trading and I leave it alone for a while. So any pattern that might be forming in this area, I'm going to disregard because that MACD is negative. I'm going to wait for it to go back to positive. Now, sometimes that means I don't take any trades for a while. But here we come back to positive. All right, so then we have a little window there. We go to negative, we go back to positive. So you have these little windows where I'm happy to trade. This is the same on ONMD. I like to trade when the MACD is open. This is when I generally find the most success and the most consistency. You start overstaying your welcome and trading past when the MACD is open, that's when you're going to get yourself in trouble. So this first move was the cleanest right here by far. We went into a little stretch where it was negative, and then it crossed over right here, which is when I got back in. for that move up. That was that $2,000 winner right there, as it squeezed through 3 and went all the way up to 320. So these are the only indicators I use. And the result is that this is a very clean chart. You can see the price action. And that's what I want. I want to be able to see the price action. I don't want there to be any question about, whether or not I caught that this is a double top here that needs to break. I want to make sure I can see the candles. That also means you need to really understand the shape of the candles. So in addition to downloading the 112-page PDF, I'm going to give you a couple more resources that you can use to help you in your trading. So, of course, I do have my book here, which some of you may already have a copy of, How to Day Trade the Plain Truth. This is called Quit, the Power of Knowing When to Walk Away. A very important skill that will be absolutely required for long-term success is knowing when to walk away each day and not overstaying your welcome. Another book that I think is a good read is the Candlestick course. This is especially good for absolute beginners. This is a book that I got early on in my career. I think it was written in 2003. So this is a book that I think is helpful. To be honest, hopefully you could find a used copy, because they charge $75 for it, which is kind of outrageous. But I remember writing here, feel solid grasp on single candle signals. Now for multi-candle patterns. So I wrote this long time ago, but this is something that did help me. I took these sort of little notes, and I was, this helped me better understand the individual candlesticks, because ultimately you have to be able to read the language. So this is a visual language. It's like, maybe in the future they'll be like, oh, these are like hieroglyphs, and it's a language, and we learn to read it. But as a beginner, you just may not understand the language yet, and that's okay. You just have to stick with it and keep studying. Anyways, Trade Mind. Oh, here it is. Trade Mindfully by Gary Dayton. This is a good book when it comes to trading psychology, because a lot of beginner traders struggle with the emotions that come with trading. The ups, the big ups, and the big downs, as I'm sure you are very well familiar with. So this book was written, in 2015. This one's newer relatively, but it's not brand new. Anyways, it's a good book, and I encourage you to read it. So if you found today's episode to be interesting, I hope you hit that thumbs up. I hope you're subscribed to the channel, and I hope you download the 112-page PDF of my favorite chart patterns and start implementing that in your trading. I encourage you to print it out and put some of those chart patterns on your monitors, because for me, one of the things that was really helpful was beginning to bridge that gap between being able to see something like this perfectly in hindsight, but not being able to visualize in real time what was going to happen next. And that's something that active traders have to get really good at. You've got to be able to visualize that this is half the pattern, which means you can see the rest of it. You can picture what's going to happen. It's like learning to read a magic eye poster, if you ever saw one of those, where you see nothing, and then all of a sudden it pops out. And that is my hope for you. So the next time you see the price of something squeezing up on a couple of big green candles like this, I want you to ask yourself, what's the news? What's the catalyst? What's driving this thing higher? And then look for that first pullback. Wait for that dip. Remember, it's going to be off of that dip that you're managing risk, right? That becomes support. Now you're looking for a move through resistance and a squeeze higher. I hope this helps you in your trading. As always, I want to thank you for tuning in. I'll remind you that my results are not typical and that trading is risky. So don't forget to manage your risk and always practice in a simulator before you put real money on the line. Thanks as always for tuning in, and I'll see you for the next episode real soon.